Hello traders, welcome to another episode of our free Forex training on Leading Forex YouTube channel. My name is Kofi, your admin for this channel. Do you remember our part 41 video, which we talked about moving averages and the type of moving averages? In that video, we talked about simple moving averages. And in that video, we realized that there's supposed to be another type of moving average known as exponential moving average. In this video, we will be talking about exponential moving averages. We will also look at how to use moving averages, whether exponential or simple moving average. We want to know how to use them in terms of Forex trading. Is that okay? And then we will look at which is better, whether the EMA or the SMA, whether the simple moving average or the exponential moving average. This and many other things are what you are going to see in this video. But if you are new to this playlist, we have a playlist on this channel known as Free Forex Training for Beginners. So just go to the playlist that I have just mentioned, Forex Training for Beginners, on this YouTube channel. In that playlist, you will see a couple of videos, about 42 videos, okay? The 42 videos there are all tutorial videos. Start from part 1, come to part 2, part 3, part 4, in that order, up to part 42. But in the part 41, we talked about simple moving averages. And we realized that there's another set of averages known as exponential moving averages. And that is what we're going to discuss in this video, along with other topics. So stick and stay with us by watching this video to the end. And I'm sure you will get additional knowledge to what you have already in terms of Forex trading. All right. So without much ado, let's go straight to the training or the tutorial for today. So once again, Leading Forex, we provide free Forex training for all subscribers and even viewers that come to our channel all the time. So if you want to enjoy more of our videos, please subscribe to our channel so that you can get more videos, all right? And also hit the notification bell so that our videos will get to you anytime it is posted, all right? And I'll also please that beg of you to like our videos. When you like our videos, it gives the YouTube algorithm the opportunity to advertise our video to more people. So once you like our video, you are actually telling YouTube algorithm that these videos are good, so show it to more people. So even if you can leave us a comment, please, the best to do for us to make this channel grow is to like our video. So make sure you like this video after you finish watching, or whilst you are watching, you can even like it so that YouTube will suggest this video to many other people. Is that okay? Thank you for doing that. Now, in the part 42 video, part 41 video, we talk about simple moving average. And we realize that there's also another type of moving average known as exponential moving average. So these are the notes of the part 41. I just want to take you quickly through the whole notes. Then we get to where we wanted to talk about the exponential moving average. Then we continue. Is that okay? So if you want to contact me, these are my contact details: on Telegram at Kofi, email leadingforexgh@gmail.com. My phone number is there, and on WhatsApp, it's the same number. You can chat me on WhatsApp. Now, Leading Forex, we just want to be an alternative in the status quo that you are stuck in. So if it is about Forex trading, we got you covered on this channel. So these are the notes of the part 42 video. The part 41. Now, in the part 41, we learned that simple moving averages calculates the periods, the number of periods you put in that average or in that indicator will determine the calculation. So if you decide to use a period of 5, it's going to calculate, maybe if it's on daily time frame, it's going to calculate the last 5 days candles. If it's on 1 hour and it's on 5 period, then it means it's going to calculate the 5 hour candles. Yes. it's going to calculate the 1 hour candles by taking the last 5 candles. If you use a 4-hour time frame, then it means it's going to calculate the last 5 candles, which are 4-hour time frames. Is that okay? Candles. So that is how the calculation is done. Depending on the number you will use as a period. So if you put in 14, 20, 25, 50, 100, 200 as your period, it's going to calculate that number of candles for you. So we also learned that sometimes when there is a spike as a result of news, simple moving average is not able to differentiate that. It calculates all, which makes it sometimes very difficult to predict or give accurate results. And we learned that after we did a few calculations. So if you watch the part 41 video, I'm sure you will come to understand all this. Now, today we want to look at how to use the moving averages. Now, this is where we'll continue. All right. This is where we'll continue by learning how to, first of all, use these moving averages. Is that okay? So how do you use these moving averages? The first thing to know is that moving averages are used as baseline to find trends. When price stays above it, it is assumed to be an uptrend. And when price stays below it, it is assumed to be a downtrend. This is one of the ways that moving averages are used. So we're going to go to the MT4 right away, and then I'll demonstrate that to you. Now, moving averages are also used as support and resistance. We will not talk about that in this video. We'll be doing that in another video. So moving averages are also used as support and resistance. So we'll look at that. Now, in that, we will also look at moving averages used as trend. And if they say trend, we need to understand what the trend is, because that's what the first point here is saying. The very first point here says that moving averages are used as baseline to determine trends. So if that is the case, we need to know what a trend is. So a trend can be defined as a general direction of the price over the short or immediate or long term. So the general direction of a market, whether the market is trending up or down or sideways, the general direction of the market, whether for a short period of time or immediate, whether it's going to be not short and not long, that is immediate, all right, or for a long period of time. Maybe the trend is just going to be for maybe few hours, okay? That is going to be a short-term trend. So we can say this trend is a short-term trend. But if it's going to be an immediate one, maybe it can take like a day or two. Maybe the trend is going to stay on for like a day or 2 or 3. That one, we can call that an immediate term trend, okay? And if the trend is going to stay on for like a month or 2 weeks or a week or 6 months or a whole year, then we can say this trend is going to be a long-term trend. So if someone says that, okay, the trend for maybe Euro USD is buy or bullish, you need to be able to find out whether the bullish the person is saying is for a short term, immediate, or long term. Do you understand? If someone should say the trend of the market at the moment for maybe AUD USD is a sell or bearish, you need to be able to find out from the person or to be able to know whether that is going to be for a short term, immediate, or long term. Because if you say the trend is bullish, the trend is bearish without giving specifications, we traders, we will make mistakes by just following that message blindly. If you say the trend is a bullish trend, you need to be able to be specific, whether for long term, short term, or immediate. Is that okay? So a trend can be defined as the general direction of the price over either a short term, immediate, or long term. You need to know. Is that okay? That is a trend. So that will also lead us to know what are moving average crossovers. We'll be doing that in another video, okay? So just keep things simple. I want you to keep things simple. by looking at trends today, okay? We want to keep it simple. So let's go straight to the MT4 and look at how we can use moving averages as baselines to determine the trend of the market. Is that okay? Good. So let me go straight to the MT4. Then we can look at this quickly. The MT4, I'm sharing the MT4 with you now. Now, this is the MT4. And we have currently on the chart GBP card on daily time frame. So let's plot any moving average. Let's use any moving average. It could be exponential, it could be simple moving average. So if you watch the part 41 video, you know how to put your moving average on. Is that okay? So you either go to the trends. When you click on trends under moving averages, you will see moving average. You see trends, you see moving average. So you click on moving average, then you decide what period you want to use. So let's keep it on 20. So 20 means it's going to calculate the previous 20 candles. So this one is on daily time frame. It means it's going to calculate the last 20 days candles. That is how the calculation is going to be done. So the period will determine the calculation. So the EMA method is either exponential or simple. So if you keep it on simple, it's going to be a simple moving average. That's what I want to say. So if you put it on simple, it means it's going to be a simple moving average. If you put it on exponential, it means the chart is going to display an exponential moving average. Is that okay? Good. So maybe let me just keep it on exponential. So this is the exponential moving average. Okay. Now, how do you use this moving average to determine trend? Listen carefully. You are going to be using it for trend. So you need to know how to use it. Now, whenever the candles are below the moving average, okay, in this case, the candles here are below the moving average. Whenever the candles are below the moving average, it is said to be a downtrend. And whenever the candles are above the moving average, it is said to be an uptrend. Is that okay? It's so simple. Look at it here. Whenever the candles are below the moving average is the red line here. So at this point, you can see that the moving average here, if I zoom well, you will see that on the daily time frame, the moving average, the candles are below the moving average. This means that the trend is what? A sell. Is that okay? It means the trend is a sell. Now, when you go back a bit, you will see at this point that here, the candles were above the moving average, on top of the moving average. The moving average is below, and then the candles are above. This is what? An uptrend, or a buy trend, or a buy trade. So this is how to use the moving averages to determine trend. It's as simple as that. When the candles are above the moving average, it means it's an uptrend. And when the moving average is up and then the candles are below, like you are seeing here, it means it's a downtrend. It means it's a downtrend, or the trend is bearish. So this is how you can use moving average to determine the trend of the market. So the moving average becomes a baseline. It becomes a yardstick to determine whether the trend is an uptrend or a downtrend. So this is a baseline here. So once the candles are below, it means it's a downtrend. When the candles are above, it means it's an uptrend. This is how to use moving averages to determine the trend of the market. Is that okay? Good. Now you know how to use the moving average to determine the trend of the market. Let's continue from our notes, and I'm sure you'll come to appreciate and understand more things with regards to this moving averages. Now, I said that I am not going to talk about moving averages being used as support and resistance in this video. And I'm also not going to talk about moving averages being used as crossovers. That will be a separate video. Is that okay? Now, let's continue from this note. Now, EMAs. Now, we want to talk about the difference, which is good. We need to know what EMAs are. Once you know what exponential moving averages are, then you can compare moving average by using simple moving average and exponential moving average to know which will be a better to use. Is that okay? So in this video, let's look at exponential moving average, because in the part 41 video, we talked about simple moving averages, their advantages and disadvantages. So we are going to look at the advantages and disadvantages of the exponential moving average too. So the exponential moving average places more emphasis on what has been happening lately. So what we are saying here is that unlike the simple moving average, which does its calculation by calculating all the periods. So if the simple moving average is 5 days, simple moving average, it's going to calculate all the 5 days. Like I showed you in the previous video, part 41. If I should go back, look at the calculation here. If it is simple moving average is going to calculate all the 5 days because the period is 5. Okay, so it will calculate all the 5 days candle. If the time frame is on 5 day or daily, sorry. If the time frame is on daily, it means it's going to calculate all the 5 days. If the time frame is on 4 hour, it will calculate all the 4 hour candles, 5 of them. If the time frame is on 1 hour, it's going to calculate 5 candles using the first hour, second hour, third hour, fourth hour, and then the 5th hour candle. It's going to calculate all that. If the time frame is on 30 minutes, it's going to calculate the first 30-minute candle, second 30-minute candle, third 30-minute candle in that order to the 5th 30-minute candle. If the time frame is on 15 minutes, it will do the same calculation. The first 15-minute candle plus the second 15-minute candle plus the third 15-minute candle, the fourth, and then the 5th. So this is how the moving averages do their calculations. So the simple moving average will calculate all the 5 and then give you the results and then plot it on the chart in form of a line. Okay. Now the exponential moving average, we are saying that for the exponential moving average, it lays emphasis on the late result. It means the current results. And let me explain that part critically. Pay attention. This is where you get the difference, okay? Now, the simple moving average is just going to calculate all these days by giving each of them equal opportunity. Take note, I repeat that again. The simple moving average, when it is doing its calculations, it will give all the candles equal opportunity. So if this day 1 candle is rated at 2, it means all the others will be given the same rate. 2, 2, 2, 2, 2, 2. Equally. But exponential moving average will not do that. Exponential moving average will lay emphasis on the current candle. So if exponential moving average is going to give the first day's price, maybe 1, it's going to give the second day candle 2. More emphasis will be laid on the current candles than the previous candles. So if the 5th day candle is giving 1, the 4th day candle is going to be giving 2, the 3rd day candle will be giving 3, the 4th day candle will be giving 4, and the 5th day candle is here, the 4th day candle is here, the 3rd day candle is here, the 2nd day candle will be giving 4th, and then the current candle, which is on the 1st day candle, which is the current candle, will be giving 5. I don't know if what I'm saying is clear. The exponential moving average is going to lay emphasis on what is happening currently and not what is happening previously or in the old or backwards. No. Yes, it is true that it is doing the calculation of all the 5 days candles, but it will lay emphasis on what is happening currently. It will give attention, if I'll put it, it will give extra attention on the price that is happening currently than what has happened previously. But for the simple moving average, it will consider all the days equal. It will give equal opportunity or emphasis to all. But exponential moving average will say, hey, what is past is less relevant. Let's concentrate on what is present. So exponential moving average is concentrating or giving the present a better opportunity than the past. So the present candles, the immediate present candles are going to be given better or heavy attention than the previous or the late candles. Is this clear? I pray it's clear. That is the difference. The exponential moving average will lay emphasis on what is happening presently than what has already happened. So although it is going to calculate all the 5 days candles, but emphasis will be laid in terms of plotting the line. When it is plotting the line on the chart, it will lay emphasis on the current candles than the previous ones. Is this clear? But when simple moving average is plotting the line on the chart, it will give all the days equal opportunity. But exponential will not do that. It will rather lay emphasis on what is happening present, currently. So the recent candles will be given a better emphasis than the previous candle. So for instance, today's candle will be given better opportunity or better chance than yesterday's candle. More emphasis in terms of the line that you will see on the chart will be laid on current candles than the previous candles. I pray you understand this. Let's move on. And then we'll look at other notes that you need to understand in terms of exponential moving averages. So exponential moving averages places more emphasis on what has been happening lately. So the present is more important to exponential than the past. Do you get it? That is point number 1. Point number 2, when trading, it is far more important to see what traders are doing now rather than what they were doing last week or last month. That is what exponential is saying. That it is better to lay emphasis on what is happening now than what has happened last week or last month. That is what exponential is saying, and that is how it does its calculations. So when you have an EMA and then an SMA of the same period, you will see that the EMA will be more closer to the price or to the candles than the SMA. And I will demonstrate that to you again. Always you will see that the EMA is closer to the candles than the SMA. The reason is because the EMA is laying emphasis on what is happening currently. And that is why it is more current or closer to the candles than SMA. So let's go back to the MT4 and then I can demonstrate that to you. So going back to the MT4. Now, I am going to delete this moving average here right now. And we are going to plot an SMA and then an EMA of the same period, okay? So let's first of all plot an SMA. 20, the period is 20, and then it's going to be simple moving average. Let's use blue color. So the period is 20, but this is simple moving average, blue color. This is SMA 20. Now let's plot EMA 20, the same period, and see. So here the period is still 20. We'll change this from simple to exponential, and let's change the color to red. The same period, but different moving averages. So the color is red. This one is EMA 20. Now look at this two. You will see that the red is the EMA, and then the blue is the SMA. And you see that the red is more closer to the price than the blue. The reason is because The red, which is the exponential, is laying emphasis on the current happenings in the market than in the previous. It is more interested in what is happening now than what has happened already. And that is why it is always closer to the chart, or sorry, the candles or the price. So whenever you hear me mentioning price or candles, it means they are the same thing. The price are the candles are the price. All right. So you will see that if it is an uptrend, look at an uptrend here, you will see that the EMA, which is the red, is closer to the candles than the blue line, which is the SMA. So they are all of the same period, the same 2020, but one is closer than the other. The reason is because the SMA, which is the blue line, is giving all the days, all the 5 candles, or the 20, sorry. This one, the period is 20, okay? So it means the SMA is giving all the 20 candles equal opportunity. But the EMA is laying emphasis on the current candles than the previous candles. So if you are rating, if EMA is rating, the 19th candle will be given less emphasis, followed by the 18th candle in that order. So the current candle, which will be the current candle, will be given more emphasis, or extra emphasis will be laid on the current candle. So this is how the EMA and the SMAs, they operate. Is that okay? All right. Now let's continue from our notes. Let me take you back to the notes and then we can finish. So we are saying that EMA is laying emphasis on current or present, whilst SMA is giving all of them equal opportunity. EMA is saying, no, I'm interested in what is happening now. SMA is saying, no, I'm interested. We are all equal. So let's give all of them equal opportunity. Is that okay? Let's continue with the notes and then quickly we can finish this in no time. So if this is the case, which one will be the best to use? One is laying emphasis on current, but not the past. But the other is also saying we are all equal. So let's give all of us equal opportunity. So will you prefer to use the EMA or the SMA? Now let's read the notes. The note is saying here that when you want moving average that will respond, listen carefully. This is what will make you or give you the advantage or will help you to decide which one to use. So listen carefully. When you want a moving average that will respond to the price rather quickly, if you want a moving average that will respond to the price quickly, then a short period EMA is the best way to go. Please, emphasis on short period. When we say short period EMA, we are talking about EMAs with smaller figures. When we say a long EMA or a long moving average, it means a moving average with high figures like 100, 200, 50. Those are long moving averages. Short moving averages are moving average with shorter periods or smaller periods. So 5, 10, 15, 20 in that order. So the bigger the number, the longer the moving average. The smaller the period or the number, the shorter the moving average. So do you understand these terms? So if I use 20 for one moving average and I use 50 for another moving average, we can say that the 50 moving average is a longer one and then the 20 moving average is a shorter one. Do you understand? Good. So the note is saying that when you want a moving average that will respond to the price action quickly, then use short period EMA. It is the best way to go. You use the short period EMA, and that is the best to go. It means if you want an EMA or a moving average that will tell you or will give you what to do quickly, to tell you that, okay, the trend is changing, so enter in the market. If you want an indicator or a moving average that will tell you that, be able to give you quick response and tell you that, oh, at this moment is the right time to enter because the trend is changing. The moving average that will be quick to give you that will be an EMA, a short one. But there's a problem when you are using this short EMA. Although you want to catch a trend quickly, it is good to always catch the trend from the bottom at the right spot very early. When you catch a trend at the early stages, you make a lot of money or a lot of pips. In that case, the short EMA will give you that opportunity to enter into a trend at the early stage. Is that okay? But there is a problem. Although it is helping you to join a trend at the early stage, what is the challenge that it presents? This can help you catch trends very early. That's the second point, which will result in higher profits. In fact, the earlier you catch a trend, the longer you can ride it and take or rake in more profits. But the downside to using the exponential moving average is that you might get fake out during consolidation periods because the moving average responds so quickly to the price. So you might think that a trend is forming when it could just be a price spike. This will be a case of the indicator being too fast to your own good, or the indicator is being too fast, your own good. So if an indicator is being too fast for your own good, then this is the challenge it will present to you. It may act very fast, helping you to catch a trend early. But what happens if the market is consolidating? It will be giving you fake signals. It will be telling you, okay, the new trend is forming, so join, when the market is actually consolidating. So this is the challenge that the exponential moving average will be giving you. It will give you an early trend entry. You will join the trend early. But when the market is consolidating, it will give you a lot of fake signals. This is what it is about the EMAs. Now that you know this, let's look at the simple moving average, which is the SMAs. Now, let's continue from there. Now we know the challenge of the EMA. Now, when you want a moving average that is smoother and slower to respond to price, then a longer period SMA, which is a simple moving average, is the best way to go. This will work well when looking at a long time frames or longer time frames, as it could give you an idea of the overall trend. So if you are looking at the market and you want the general trend of the market, then it will be good to use SMAs. And the simple moving average, you'll be looking at long-term or longer time frames. So once you go to maybe 4-hour, daily, weekly, monthly, you'll be able to get the general trend of the market. So SMAs with longer time frames will give you a perfect picture of the general trend of the market. So if you are looking for general trend of the market, then SMAs will do you that good. But if you are looking for general trend on smaller time frames, then SMAs will not be good for you. Do you get the difference? If you are looking for the general trend on longer time frames, like 4-hour, daily, weekly, and the rest, then that one, the SMA will be best to give you that opportunity. But if you are looking for the general trend on maybe 1 hour, 30 minutes, 15 minutes, 5 minutes time frame, then the SMA will not be your tool to use. Because if you use that, it will always delay you. It will give you a delay, which will not help you to interpret the market the right way. Are you getting it? So although it is slow to respond to the price action, it could possibly save you from many fake outs. So whilst the EMA will be giving you 4 signals because it is quick and then it responds to the market very quickly, the SMAs will not do that. SMAs are slow to react, and so they will not be giving you the fake outs. Okay, so SMAs will not be giving you the fake outs on longer time frames, but EMAs will be giving you fake outs, especially when the market is consolidating. But what is also the problem with the SMAs? Although the general trend is good with SMA, is there any downside of it? Yes. The downside is that it might delay you too long and you might miss out on a good entry price to the trend altogether. So when the trade is about beginning, when the trend is actually starting, SMAs will not be able to give you that opportunity to enter early. But EMAs will give you the opportunity to enter early. But sometimes the EMAs will give you fake outs, which SMAs will not. But the fact that SMAs are not giving you the fake outs doesn't mean it is also the best. It is slow, and so it will not give you the fake out. But it is also slow and will not help you to enter into the trend at the right time. A trend may go halfway before SMA will tell you to enter. By then, the trend is far gone. Do you get the difference? Whilst SMA will delay in helping you to enter into the market early, EMA will help you to enter into the market early or join the trend early. Whilst SMA will not give you fake outs, EMAs may give you fake outs because sometimes the market is actually not starting a new trend. Maybe it's only consolidating. So whilst EMA will be telling you, hey, it's time, a new trend is being formed, join. SMA will say, hey, I don't see anything like that. Hold on. Then before SMA will say, okay, now I see a trend, please join. By then, SMA has done that long time. And if those who listen to SMA will listen to EMA, EMAs will enter into the trend very fast. So whilst SMA will be telling you it's time, now I see the trend, go in. By then, EMA has seen that trend long time. Do you get the difference? So this is the difference. This is the difference between SMA and EMA. They all have both sides of the coin, positive and negative. So if this is the case, is there a way you can combine SMA and EMA? That is my question that I want to ask. Can we use EMA and SMA together? That will be my question. And what do you think will be the answer? Tell me. What do you think will be the answer? Is there a way we can use EMA and SMA together? Although this one is giving you early entry, the other one is giving you late entry. The one giving you the early entry can also give you fake entry. Whilst the one that is giving you late entry will actually give you an entry that is far gone. So is there a way we can combine the two and use? Yes, there are people who want to use both EMA and SMA because of this. You understand? So we will be looking at that. So that is what is going to lead us to what we call moving average crossovers. So one is crossing the other to say that, okay, do this. And that is where we are also going to talk about people using them for support and resistance. Is that okay? So we still have a lot to talk about. But today, you have come to realize that we have SMAs, which are good and also bad. And then we have EMAs, which are also good and also bad. So can we combine the two, or we can stick to one? So we're going to look at moving average crossovers. We're also going to look at moving average as support and resistance. And then we might also be looking at moving average as envelopes. And then we may also be looking at multiple moving averages. Okay, multiple moving averages. This is all about moving averages. Now, I will also advise that maybe there might be a YouTube channel out there that might be giving you a good moving average strategy. Now we are going to go into the strategies. So maybe you can watch other YouTube channels that have moving average strategies, because now you know how they work. You know how exponential moving averages work, and you know how the simple moving averages also work. So maybe you can look at other channels that have good strategies for moving averages, and then you can try them and see if you can get something good out of it. But I'm now going to go into the strategies: the moving average crossover strategy, the moving average support and resistance strategy, the moving average envelope strategy, and then the multiple moving average strategy. So we'll be looking at these strategies, and then you can experiment them to see if any of them will do you some good. Is that okay? So we will end today's video here. In our next video, we'll be looking at moving average crossovers as a strategy, how you can use that to enter into the market. Okay, but if you want to trade the trend, okay, if you want to trade moving averages as trends, we will look at that also. Okay, so please stick and stay. There are more to come. And then also we can look at whether to use a fast moving average with a slow moving average. We can look at that too. And then there are crosses. Okay, we'll look at all that. So please subscribe to this channel, hit the notification bell, so that the next videos that will come, you'll be the first to have it or to see it, and then to be able to watch. Also like our videos, so that it will help the YouTube algorithm to actually show our videos or showcase our videos to other people. Is that okay? So please like our videos, and God will bless you for that. This is where we'll end for this video. My name is Kofi, your admin for this channel. I'll see you in another video.